Good morning from our global headquarters in New York. I'm Manus Graney alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Brace for discomfort. President Trump warns of a little disturbance while defending his trade policies. The Lutnick effect. The Commerce Secretary hints at tariff relief, lifting equities off the worst two-day slump since December. And Germany's whatever it takes moment. The new chancellor readies hundreds of billions of euros in spending. Good morning, Manus.
Danny, good morning. Just how far will they push the discomfort? Because this stock market whipped it around yesterday after that worst two-day slump since December. Commerce Secretary will be with us later today talking about relief. Well, relief does not equal reversal, and reversal does not equal a reduction in uncertainty. Stocks, however, are reclaiming some ground this morning. Roll it over to the bond market. Of course, the Nasdaq almost corrected yesterday. Look, the narrative was steepeners in the market. 424 is where we are. The two-year yield steadies itself at 398, but you are looking at a momentum in these yields. The longest drop in yield, Danny, since 2020 as stagflation takes hold. Keep an eye on euro-dollar. It's bid this morning on this. Almost unconstrained defense spending from Germany, and the euro is rocking away in terms of the upside. So things are shifting on a seismic scale globally.
Yeah, take everything you knew about Germany and their spending and just rip it up. There's also some individual stocks that are moving on those Lutnick comments. Broadcom, I should say the entirety of the chip sector, but here's a look at Broadcom, up 2.5% in the pre-market. It's one of the sectors rebounding. Commerce Secretary Howard Lutnick speaking on Fox yesterday, saying that the administration will meet in the middle, is what he called it, with Canada and Mexico.
And another sector to keep an eye on for relief. Howard Lutnick's comments is the auto sector. General Motors rising pre-market. As I said, this is 4% of the GDP of the United States of America, now tariffed at 25% from Mexico and Canada.
And some earnings to check on for you. CrowdStrike shares falling more than 8%. The cybersecurity company issued a worse than expected outlook. It is still recovering from that flawed software update that crashed millions of computers globally last year and likely led many of you to miss your flight.
And in just a few moments, we'll catch up with David Lebovitz of JPMorgan, and later in the hour, McCormick of TD Bank. And don't forget that conversation with the Commerce Secretary, Howard Lutnick. What does relief look like? What is it that may well be offered? Danny, here's the point. What is a little disturbance? What happened yesterday? Did we test the boundaries of where this administration went? Maybe there's a little bit too much pain in this market.
Did we see a Trump put of sorts come in? Trump kind of downplayed that during his congressional address, but I think it's also interesting to contemplate, is what we saw yesterday a growth scare or a tariff scare? Is this just economic data that's been weakening, and then you add tariffs on top of it and it gets worse? Because the things that we saw sold off, things like banks, for example, that is a telltale sign that we are concerned about the economic growth of America.
Look, the stagflation narrative is mounting, so the question then becomes the rates market leans into the stag side of this, which is 3 rate cuts rather than the inflation side of this. So it's really that rock and a hard place for the Federal Reserve.
Certainly. And look, it has been 2 days of tariff pessimism that dragged stocks lower. Now, a flash of optimism did come in the form of Commerce Secretary Howard Lutnick last night. In an interview, Secretary Lutnick seemed to suggest that there may be some compromising on tariffs coming.
Now, both the Mexicans and the Canadians were on the phone with me all day today, trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more, and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
Joining us for more is Bloomberg's Kevin Whitelaw, and we again should emphasize that Lutnick will be on with the surveillance team. So maybe we will get that announcement soon, Kevin. But meet in the middle, is this the Trump put coming to realization?
Look, I think we're still trying to figure out, and maybe Trump even himself is still trying to figure out, ultimately, what is the aim of these tariffs, right? And he's unleashed a bunch of tariffs. He's threatened a lot more. And how much of this really is about negotiating? How much of this is about getting concessions, whether it's related to the illegal drug trade or bases of manufacturing or other kinds of trade measures? Or how much is he really counting on revenue from tariffs to fund his priorities, whether it's tax cuts or other spending priorities? He's talked even about getting rid of the income tax. At some point, you can't sort of have it both ways. And so the administration is going to have to ultimately decide what is the point of this and what do they want to do with them. And it's very clear that the jitters you're seeing in the market are related to a concern that, indeed, he's talking about something more structural, something more permanent. And if that does happen, then that becomes obviously a huge, huge potential shock, not just to the U.S. economy, but to some of the global economy, if he really goes down that road. So obviously, I think there's, in Europe and elsewhere, there's a lot of people hoping that Lutnick is indeed representing a rising power within the administration, which we do think is actually somewhat torn between these different ideas.
Well, as he says, it's not a pause, but we need to understand the quantum of relief. Look, aside from tariffs, Trump touched on a number of issues: taxes, Ukraine, Doge, the CHIPS Act. This was all last night. Here's some of the highlights.
The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. We're seeking permanent income tax cuts all across the board, and to get urgently needed relief to Americans hit especially hard by inflation. Your CHIPS Act is a horrible, horrible thing. We give hundreds of billions of dollars, and it doesn't mean a thing. Simultaneously, we've had serious discussions with Russia and have received strong signals that they are ready for peace. Many more have been found out and exposed and swiftly terminated by a group of very intelligent, mostly young people, headed up by Elon, and we appreciate it. We found hundreds of billions of dollars of fraud.
So, Kevin, he talked about a common sense revolution. It was very partisan. It was 100 minutes long. When he used that phrase, little disturbance, this was very much raising the flag. The discomfort is far from over.
No, I think that as long as he's going to keep unfurling tariffs, as long as he's going to pursue elements of this, there's going to be disruption, there's going to be pain, there's going to be questions about what it means for consumers in the United States as well as for businesses. I mean, for businesses just trying to plan their future and trying to figure out investments, a lot of them suddenly really don't know how to think about what that environment's going to look like and what some of that decision-making really means, because they don't know what the landscape's going to be in a couple of years. And so I do think you're at that situation where at some point the market, the players, the businesses, they're looking for some clarity about what exactly is the ultimate strategy that Trump is pursuing when it comes to tariffs, and how serious is he.
OK, well, we'll get a little bit more information today, won't we? Kevin Whitelaw there with us for the very latest. Thank you very much. And thanks to tariffs becoming a reality. Just look at this. Stocks, the S&P 500, the worst 2 days since December, down almost 3%. Oil this morning looks to be holding its losses. You're looking at that market down almost 4% over 4 days. And 10-year yields back at 4.25. David Lebovitz joins us now from Multi-Asset Solutions for Global Strategy over at JPMorgan Asset Management. David, good morning to you. These markets are in a febrile state. If we look at the narrative, we're going to hear from from Commerce Secretary later today. He says it's not a pause. So then what kind of relief should we be looking for at this current moment?
So I think there are a couple of things going on there. And you know, the base case should be that there are going to be tariffs. I think it would be very surprising, as a number of people have said, to see the whole tariff narrative walked back. I think more clarity on the direction of travel, right, a more narrow dispersion of outcomes is what the market is really looking for, because effectively what's going on here is you're seeing this slowing in growth at a time where policy uncertainty is rising. And that's very difficult for markets to digest, hence the volatility that we've seen over the past couple of days.
So, David, I'll ask to you kind of what I posited to Manis at the top of this show. Is what we're witnessing a tariff scare or a growth scare in markets?
So I think that the two are interrelated to an extent, because the downside that tariffs create from a growth perspective, again, is coinciding with an economy that is simply returning back to trend. And so I think the question that the market is asking itself is, we grew at about 3% in 2024. We're not going to do that in 2025. Are we stepping down to 2? Or are we stepping down to 1? And so it's a growth scare that's being exacerbated by what's going on with tariffs. And again, the broader policy uncertainty and more stick, less carrot, I think is part of what's causing markets to gyrate here, as we've seen.
So, David, if we're stepping closer towards a growth scare, that builds the stagflation narrative. I'm just curious to get your take. The market's pricing in 3 rate cuts. Is that the right response mechanism from the market if we are heading towards a stagflationary environment?
So stagflation is public enemy number one, right? That's the environment that you want to avoid. Stagflation is not our base case when we think about 2025. And frankly, the Fed easing 3 times this year against the backdrop of sticky inflation and softening growth, I think you'd have to see a fairly material softening in growth for that to be realized. We're still of the view that the Fed will cut rates 2 times this year. That's been our view since since December of 2024. And so we think that there is Fed easing coming, but I'm not sure it's going to be quite as substantial as what markets are currently pricing in.
David, you mentioned the gyrations of this market, and it's that old adage that over any given time frame that markets have momentum and they follow a trend, but in transition periods, they bounce around quite randomly. Are we witnessing a random bounce of a transition period, or have we transitioned already into a new trend that looks like one for vulnerability of risk assets?
So I'm not sure that we've fully transitioned into a new trend. I would point out that growth is not terrible. Inflation has come in quite a bit, and that nominal growth environment is still very positive when you think about things like corporate cash flows and corporate profits. So what I think the market needs to see here is just a little bit of good news to get back on the track that it's been on over the past couple of years. I'm not saying that the S&P 500 is going to have another 20+% year. That would certainly catch me by a bit of surprise, but I do think that stocks, U.S. equities, are higher at the end of the year than they are today. What we need to see is this constant flow of negative news, whether it be around the growth numbers, whether it be around the policy decisions that are being made. We need to see that transition, and frankly, I think it will. I think this Friday's jobs report is going to be particularly important in setting the tone for the month of March more broadly.
Well, that is the tier 1, the top of the tier 1 data. David, Dawn Fitzpatrick yesterday joined us and she said consumer confidence and corporate confidence is falling off a cliff right now. What changes that? Because that is the core. Danny's talked about this in terms of the wealth effect. That is the core of confidence in exceptionalism in the U.S. and global risk assets.
So I think just seeing policymakers make a decision would go a long way in reducing some of that downward pressure on both corporate and consumer confidence. I mean, if you think about running a business, it's very difficult to plan if you don't know what the rules are going to be, if you don't know what tax policy is going to look like, if you don't know what tariff policy is going to look like. If you're a consumer and you're living paycheck to paycheck, very difficult to budget if you don't know what's going to happen to the prices of the goods that you're buying on a day-to-day basis, what's going to happen to the price of the gasoline that you put in your car. And so, again, the policy conversation today is creating this uncertainty, whether it's on the business side, whether it's on the consumer side, and that makes decision-making very difficult. And, economic growth slows when people decide to wait and see. It is imperative that we get past this point where we are today so people and corporations aren't waiting and seeing, because if that's what plays out, we likely have more downside risk to growth than we're currently penciling in.
You could argue investors feel the same way about that uncertainty. David, it's kind of a weird thing to see some of these sentiment readings crash. I don't think it's an exaggeration to say that. Looking at AAII surveys, absolutely plummet, and the number of bears rising to 60%. It feels like a time of when others are scared, be greedy, but we're not even off 10% of the highs of this equity market. What do you make of that disconnect between sentiment and, let's be honest, a market sell-off that hasn't gotten that deep yet?
I think you make a really good point, Danny, about the depth of the pullback that we've seen. It's still fairly pedestrian, down mid-single digits from the peaks. Sentiment is deteriorating, and I think, frankly, what's been going on, if we look at the markets globally, is you had a U.S. market that's done very well over the past couple of years, and frankly was sporting a valuation that was unsustainable. You had global investors say, okay, there's clearly policy risk in the U.S. Maybe I'll look to some of these more favorable valuations abroad, and I think that that's a big part of what's driven the performance of European equities over the course of the past couple of months. But now when we look at international markets, they're not sporting the same discount that they were a couple of months back. the U.S. has re-rated marginally. I think, frankly, if we're going to continue to operate in this environment of policy uncertainty, right, you have less dispersion within valuation, right? That means the U.S. multiple comes down, the rest of the world has gone up. But I think, there could well be some more fluctuations in the market as we get clarity here. I think, April 1st is going to be particularly important. We get the big report on trade coming out of Washington. There are still questions that investors want answers to. And I think the fact that futures are up today, certainly isn't sounding the all clear.
David, so brilliant. As always, it is such a pleasure to have you on our show. Looking forward to seeing you in person next. David Lebovitz of JPMorgan Asset Management. Let's get you some other stories now that are trending on the terminal this morning. Shares of Adidas falling. The German sportswear brand said earnings will grow slower than this year than investors expected. Shares down a little bit more than 0.5%. That happening even as it builds momentum with its retro footwear. It is known, I will say, for conservative guidance, but analysts said that the latest figures would likely weigh on its shares in the short term.
Within weeks of President Trump wanting the U.S. to take back control of the Panama Canal, BlackRock's Larry Fink got in touch with the White House. Now the world's biggest asset manager will lead a consortium that will buy a controlling stake in Panama ports. The transaction represents the largest infrastructure deal in BlackRock's history.
Meanwhile, China has set an economic growth goal of around 5% for this year. It upheld its growth plan with the highest fiscal deficit target in over 3 decades. The government also unveiled a plan to increase its sales of special bonds to fund more public spending.
Coming up in the show, Germany abandons its fiscal shackles. Bund yields surge. More on the German story next.
It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. Germany has announced plans to unlock hundreds of billions of euros for defense and infrastructure investments. The euro is on course for its largest 3-day gain since late 2022. Investors betting that the increased spending by Germany and others will boost the European economy. Pleased to say that joining us now is Bloomberg's Chad Thomas in Berlin. Chad, can you just try to quantify what sort of change this is, the level of change, and just what it means for Germany to have this spending and having the release of the debt brake?
Hi, Danny. Well, it was a real shocker last night when this was announced, and we've had economists saying that this is the biggest change in fiscal policy in Germany since reunification in the 1990s. You have to remember that Friedrich Merz, he's the leader of the conservatives here in Germany. It was his party under Chancellor Merkel who put the debt brake into place. That's the mechanism that restrains the fiscal spending in Germany. So the fact that he came out last night and said that they're going to remove all defense spending from this fiscal limit, and at the same time they're going to have this 500 billion euro fund for infrastructure, that was a real big move. And we, of course, saw the market reaction today with the euro, with bunds, and also with defense stocks across Europe as well.
Chad, good morning to you. You just take this along with the pan-European response and you begin to understand the scale of what we have. But the question is, how much of this can be assumed to be a done deal? Because this is Merz going back to the old parliament, not the new parliament. Yeah, it's a really interesting thing that we'll see playing out here over the next week. So the old parliament is still the sitting parliament. The new one that was elected a little bit more than a week ago hasn't been sworn in yet. And for these changes that he's talking about doing, he needs a 2/3 majority in the parliament. He doesn't believe that he would have that in the new parliament, so they're actually using the old one to try and get this through. He will need the support of the Greens to get this through. He has been talking with the Social Democrats. They're his likely coalition partner in the new government. The Social Democrats last night said they do back this proposal, but it will, it's likely, Manis, that it will go through, but it will remain to be seen if he does muster the votes next week in the parliament for these measures. Okay, Chad, thank you very much. We'll track that. No shortage of superlatives from the market this morning in terms of the size and the scale and the impact. Chad Thomas there on the latest release from the fiscal break in Germany. We've been showing you the prices throughout that, but let's just check in, Danny. We've got real sort of shifts in the euro dollar. You've got it touching a 4-month high, the largest 3-day gain since 2022. And I like what George Saravelis says over at Deutsche Bank. It's the biggest and fastest fiscal shift post-unification, and he's going for 110. They're shredding these parity calls.
Yep, he has upgraded his target, saying that this creates upside growth and mutes the impact of tariffs. By the way, the superlative for you, that move on bonds up 19 basis points. If it holds, it will be the biggest one-day move since March 2020, the onset of COVID. We'll have more on that, plus other news for you on your Bloomberg Brief.
Let's get you to speed with the front pages from around the world. First up on Bloomberg, President Donald Trump called for the ending of the bipartisan $52 billion CHIPS Act. Trump called it a horrible thing, he said in his primetime address to Congress. His remarks were met with applause in the chamber that passed the CHIPS and Science Act less than 3 years ago.
Next up, the Wall Street Journal leads with this, that President Trump read aloud a letter that he received from President Zelensky, voicing regret over their Oval Office meeting. He set out his vision of a path to peace. It was his most concerted public effort yet to repair the relationship with Trump. Trump did hold back from lifting a U.S. pause on military aid or announcing a revived minerals deal during his address.
Let's finish off with the New York Times. Leads with the Democrats responding to the president's address. Senator Alyssa Slotkin arguing that his agenda would be costly for Americans and leave them less safe. Slotkin also criticized Trump's foreign policy and accused him of cozying up to dictators and mistreating allies.
Well, coming up on the show, North American tariff relief and Germany's infrastructure boost. A lot of movement in currencies. We're going to catch up with McCormick of TD Bank next on what he sees as dollar strength to come. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger here alongside Manish Krani. Let's set your agenda.
Brace for discomfort. President Trump warns of a little disturbance while defending his trade policies. The Lutnick effect. Commerce Secretary hints at tariff relief, lifting equities off the worst two-day slump since December. And Germany's whatever it takes moment. The new chancellor readies hundreds of billions of euros in spending. Danny, good morning.
Well, we probably packed, I don't know, let's say a year's worth of news into the past 24 hours. We tried to rebound from the sell-off yesterday, which, by the way, I think the technical term for that would be a reverse N shape, down, up, down again. And now up again. Volatility has been off the charts. The S&P has wiped out gains since the election. At one point was down 2%. NASDAQ futures lead the gains at 0.7%. Russell 2000 outperforms up 1.2%. Did we witness the Trump put? When it comes to bond markets, that was also a very volatile morning, too. The front end dropped by as much as 11 basis points at one point yesterday, only to end the session higher. We go back down again, down by about 2 basis points in your front end. 10-year yields, that's at 4.2%. But the real movement comes from Germany. A 17 basis point push higher in your German 10-year yield. If it sticks, would be the biggest move higher for German bond yields since March of 2020, the onset of COVID. You see the reaction in the Euro 2, Manis, that off the back of Germany's whatever it takes moment, announcing one of the largest fiscal regime shifts in post-war history.
Well, as you said, Danny, we've had decades worth of policy moves in a matter of hours. Let's take a listen to the late-night remarks from the Commerce Secretary, Howard Lutnick, that pulled stock investors out of that worst two-day slump since December.
Now, both the Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
Our senior editor, Michael Shepard, joins us now from Washington. Shep, good morning to you. Relief, so we're not going to get a pause. Relief is not a reversal. It does not equal uncertainty reduction. What is it that Howard Lutnick could possibly say in the Bloomberg studio today that really changes the narrative?
Well, it would really have to be, we have an agreement. They have to come forward and say, look, Mexico and Canada have indeed met us halfway, as I said on television last night, and the president is ready to accept it, and we are ready to move along. And during his remarks last night to Congress, in fact, Donald Trump gave no indication really that there was any kind of a break or relief or nowhere near a pause whatsoever for these levies against major U.S. trading partners. And in fact, we heard him signal instead that it would be full steam ahead. Remember, Trump really does see tariffs as an economic panacea. It's a way of balancing these trade relationships that he sees as unfair, and many of his advisors, including Howard Lutnick, endorse as well as being unfair, as a way to solve that while also raising revenue to support a lot of the president's priorities, including all those tax cuts. So today we may be able to get some communication from Canada and Mexico about moving closer to perhaps a little bit of relief, but it is not going to be a total pullback from the brink on these tariffs. We've already jumped over that, and we're now seeing equity markets really reflect a lot of those concerns about tariffs as well.
Right. We certainly didn't get any new news from Trump in his address yesterday. Again, just saying that there's this idea of what he called a little disturbance from tariffs. Shep, I just want to go through some of the other president's comments yesterday. Let's take a listen.
The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. We're seeking permanent income tax cuts all across the board, and to get urgently needed relief to Americans hit especially hard by inflation. Your CHIPS Act is a horrible, horrible thing. We give hundreds of billions of dollars, and it doesn't mean a thing. Simultaneously, we've had serious discussions with Russia and have received strong signals that they are ready for peace. Many more have been found out and exposed and swiftly terminated by a group of very intelligent, mostly young people, headed up by Elon, and we appreciate it. We found hundreds of billions of dollars of fraud.
Shep, did we come away with this with a greater understanding of what the president's priorities are at this moment?
Well, clearly he is trying to go after, and he spent a lot of time talking about what Elon Musk's Doge effort is trying to do with the U.S. government, and that is look through all the couch cushions at the agencies for any kind of savings that they can find. Now, what we've seen so far is that a lot of those savings really have not translated into actual savings. They've turned up contracts that were canceled years ago, and some of the numbers just simply don't add up from this so-called Department of Government Efficiency. But that didn't stop the president from reeling off a list of some of the programs, that many of them foreign aid initiatives, that have been canceled or put in abeyance, and he tried to use them as a way to ridicule some of the past administration's priorities as well. And that also included the CHIPS Act, interestingly, Danny, and his call for repealing this measure really is something that chip makers will have to pay close attention to. While the subsidy program has been passed and we've seen these agreements signed with major semiconductor manufacturers, a lot of the money is still in the U.S. government's hands. That those checks only go out on the basis of certain milestones and achievements being reached by these companies under contracts that they've signed with the government. So whatever Intel and TSMC and others are about to get, it's based on those agreements that they've signed. And a lot of it is based on what they're achieving in terms of building plants, hiring workers, and meeting other goals along the way. Right. Now, repealing it is a tall order, because this passed on a bipartisan basis, and we don't see a huge majority at all in the House that would be able to get him the numbers he would need to win an actual repeal of the law in Congress.
Mike, so much to keep track of. I know it was a late night for you and an early morning this morning. Thank you so much for joining us, Michael Shepard there. Now, the dollar has been falling for much of the past month. It took a nosedive deeper into the red yesterday. TD's Mark McCormick writing this: we continue to like U.S. dollar upside here, believing that the positioning adjustment and drawdown are complete. Mark, I'm pleased to say, joins us now. He's global head of FX and EM strategy at TD Bank. Mark, it seems like if there's one thing that unites everyone around tariffs, it's that the consensus is that it creates a strengthening in the dollar. Both foes and fans of the dollar think that. So what do you make of the dollar, not just the action for the past month, but also yesterday in the whole tariff scare? getting a weaker dollar out of it?
Well, I think it's been a very challenging environment, largely because there's push and pull factors. I think on the one hand, you can have the markets been complacent on tariffs. We've seen a reduction in risk premiums. We've seen valuations kind of move and positionings adjust, especially the markets kind of move from a very long dollar position to neutral to what now feels like in our models to be very short. At the same time, you've seen a complete collapse of U.S. data. If you look at the Atlanta Fed GDP tracker, it's negative for the first time in years. And also you're seeing U.S. data surprises underperform. So I think what we're trying to pull together is the market's trying to be forward-looking. It's trying to understand a complete readjustment of the global trade order and the existing regime that we've been a part of. And what we're seeing is on the forward-looking side, the America First agenda is now pushing other countries to kind of take care of their own economic policies. So this is what you're seeing out of Germany, the fiscal support and the change in the defense and the spending that they want to see there. But it's coming at a time, if you went through like Trump 1.0 with trade wars, basically what they did the first time around is they put tax cuts and deregulation first, and then they followed up with tariffs. So now what you're starting to see is the data looks a little bit funky. It's been very volatile, at least from the U.S., and people are questioning whether or not U.S. equities are still the main place to be. So there's a rotation and a concern around whether or not the U.S. is really exceptional and whether or not U.S. equities are the place to be, which is basically two pieces of the dollar trade that we're looking at right now.
Mark, good morning. And despite all of this geo uncertainty, one typically buys the dollar. The question that's being asked by a number of proponents this morning is whether this profound geo-economic uncertainty, the highest tariffs since the 30s, pulling military assistance from Ukraine, et cetera, we could go on. But the question becomes then whether U.S. hegemony and exorbitant privilege can be challenged, materially challenged, if not in the short term, but by the end of this year and the rest of this tenure of Trump.
Well, I think in terms of the hegemonic power, it's clear that there's kind of a battle around it. You know, people have used the term, it's a multipolar world, and that seems very clear. And that's what you're seeing from Europe. Europe is essentially saying, you know, Europe is taking care of Europe, America's taking care of Americas, and Asia is basically driven by, you know, an influence around China's sphere. So this is part of what you would expect in terms of, you know, a lack of a hegemonic power is that the power is diffused among a couple different spots. So I think when this comes back to markets, what's very interesting, and this is kind of the pivot point that everyone's trying to figure out, for the first thing, if you don't have the same existing global trade order, you are going to have much higher inflation. You're going to have much steeper yield curves. That's what you're primarily seeing that's coming across in Europe is we're starting to see a repricing of the term premium and the growth expectations. I think also at the same time, you're going to see what could be a potentially slower growth world. Right now, everyone is very excited about what's happening in Germany and the defense spending. But again, this has to get through a constitutional change. This will probably have to get through courts. So I think most of us should be very skeptical that the numbers we're seeing out of Germany will actually come to the realization. But again, markets work on the expectations of things and they adjust accordingly as the news flow comes out. But I think, again, back to the hegemonic story, like this is what's happening is the world is changing, foreign policy, geo-macro, all these things are adjusting and markets just can't put down a trend and just can't sort it out. So we're seeing tremendous amounts of volatility, like you said, like within a day where it feels like a decade.
Yeah, it's the transition period for trying to find that new trend where markets tend to be bumpy. But when it comes to Germany, we've already seen your peer over at Deutsche Bank, George Saravelos, upgrade his euro target to 110, arguing kind of what you're pushing back against, this idea that we will see more growth and it shrinks the differential between the U.S. and Europe. You have said that you see euro going lower. Would you adjust that at all? Again, maybe not necessarily on whether it will get done, but a market expectation that you will get an easing of the fiscal brakes.
I think an important piece here for anyone who covers FX needs to understand that the drivers you see on a monthly basis and a weekly basis are extremely different than the drivers you see on a monthly and a quarterly basis. Short term is tactical, it's positioning, it's short-term valuations, it's market sentiment, and the longer term is driven by much more complicated factors. So I would say here tactically, for the rest of this quarter, we are still bullish the dollar. We have been looking for the end of this year and into next year, a euro at 110. Whether it was through a Mar-a-Lago Accord or was it through natural decline of U.S. exceptionalism, what we've been suggesting is the dollar story would peak in Q2. I still think that's the way to trade it. I would say on those short-term metrics, especially when we look at positioning and the things that drive our models and our overlay tools, euro positioning is now in the 80th percentile. So it's basically almost at the max we've seen in the last 6 months. So now what we need to see is the continued positive news flow has to support the euro. And as you just noted in the last segment, the next thing that's coming from the Trump administration is tariffs on Europe, and also a focus on deregulation and tax cuts. So while the U.S. economy is kind of stumbling, at least from a data perspective, our data momentum indicators show that the U.S. is still outperforming Europe. So I think we can totally see this narrative change on a dime, just in a span of a couple of weeks. But I would highlight again, we are looking for the dollar to turn lower. That is a forecast, but our trading conviction is to buy the dollar tactically in the short term.
Okay, we're going to test that exuberance of the euro at some juncture. Mark, thank you very much. Mark McCormick there of TD Bank. It's Bloomberg Brief. I'm Manus Cranley alongside Danny Berger here in New York. Well, Germany announced its pretty shocking plans to unlock hundreds of billions of euros of defense and infrastructure investments. The euro on course for the largest three-day gain since late 2020. Bunds plunging on the back of the shift. Yields are spiking. I think, Danny, you gave us that stat. It's the biggest one-day move in the Bund yield since the onset of COVID, and that was back in March 2022. Joining us now is Ross Matheson. Ross, good morning to you. This is Mercer's do whatever it takes moment. Can you just give us the size and the scale on defense and infrastructure that's on the table? Because there's a great distance between what's proposed and actually delivering.
Well, that's going to be the big question, really. Here we can see, as you were saying, markets reacting today to what is really a very, very proactive move by the incoming Chancellor. He's not even in the chair yet, already working with the outgoing administration to try and get some sort of deal towards Parliament. And that just reflects how fast-moving an environment we're in the world right now when it comes to politics and to defence in particular. So the question is, what can he get done and how quickly? Because obviously he needs to work with Parliament. He needs to get enough parties in Parliament to essentially change the Constitution. And, you know, with his group and Olaf Scholz, the outgoing Chancellor's group, he doesn't have enough. So he's going to need other parties on board to do that. And do those parties feel that they've not been part of this sudden announcement and therefore they're feeling a bit indignant about it? So you need those parties on board to get something done. Do you find that it gets watered down a bit as a result? So this might be the opening salvo, dare we say. This is the big headline figure. What in reality can Merz and Scholz get through Parliament might be something slightly smaller. But either way, it's a really significant moment for Germany. As you were saying, this debt brake has been in place through many a crisis before, the Euro crisis, the COVID pandemic. It took Donald Trump essentially to bust it up and for Germany to say this is the moment we have to do this. So it's a really big step either way. It's just unclear whether the amount of money that they're talking about is what's going to get through.
And Mark McCormick of TD Bank was just with us, Roz, saying something similar. In fact, he threw cold water over the idea that we would have anything close to what we're looking at. So what does the timeline look like from here on out? What do negotiations look like? How do they take form? What are sort of the things we need to be watching out for?
We need to watch the Greens and all of this because that's probably the party that they're going to need on board to get something through Parliament. And we can see already the Greens saying, hang on, we've been ambushed a bit by this announcement. We didn't know this was really going to be coming so quickly. And so now they're going to come in with their list of concerns or rather demands about this plan. And so the parameters of, again, could change. We also have the far right, you know, the AfD, which will become the most important party in opposition. What is their view? Are there legal challenges? So, yeah, a lot of obstacles ahead, potentially.
Roz, thank you so much. That is Bloomberg's Roz Matheson. Now, over in China, the government has set a bullish growth target of about 5% for this year and a record-high fiscal deficit target of 9.9% at the latest annual National People's Congress. For more, let's bring in Bloomberg's Minmin Lo, who joins us now from Beijing. Minmin, there had been this idea that China was reserving fiscal power until they understood the impacts of tariffs. Is this it? Is this the fiscal bazooka finally coming to realization?
Well, I am not sure I would call it a fiscal bazooka at this point. Yes, the growth target is pretty aggressive, but it's in line with expectations, the 5% growth target, because consensus forecast is 4.5%. So to get to 5%, they really have to pull out a significant amount of stimulus to boost the economy. And the deficit target does match that. It's set at 4%, which is the highest in decades. The local government special bonds, as well as the sovereign special bonds, the quota for those had also been raised as well, but that's where it had fallen slightly below expectations. Some analysts say that the fiscal budget spending may still not be enough to hit that growth target, but we'll have to see, because it's possible that the government will revise the budget mid-year as well. They could be keeping their cards close to their chest for now while they work out what the final tariffs will be, because at this point there still hasn't been any high-level official talks between President Xi and Trump to discuss what the final tariffs will be going forward. So we'll have to see. But this is pretty aggressive. And what stood out to me the most in that government work report is the priority of the government. The first number one task listed there is to boost domestic consumption. It's no longer about promoting those so-called new quality productive forces. That was the number one task last year. Now that's relegated to number two. The focus this year is all about boosting domestic consumption. And that signifies maybe not that there is a strategic pivot away from that industrial policy, but it's a more balanced sort of macroeconomic framework that they're looking at here.
Well, still, the survey that we've done, 77 analysts think it's only going to achieve 4.5% growth, not the 5%. Where are we in policy mix? Because as tariffs arrive, the response mechanism has been to devalue the currency, but that has been restrained, even though the market sort of saw that as being one of the ballasts to tariffs. So how do they boost consumption in a rising tariff environment with a steady state currency?
Yeah, the currency, again, that was mentioned in the government work report as well. In terms of the currency policy, the government is still going to keep the yuan stable in a balanced and adaptive manner. And so far, year to date, we have seen a laser-sharp focus from the PBOC to focus on defending the yuan. It looks like they wouldn't want to be accused of manipulating the currency or deflating the currency to offset tariffs, especially given Trump's recent comments naming the yen and the yuan specifically in that currency watch list. So we'll have to see when exactly the PBOC would shift the policy towards that more accommodative monetary policy. That's something the PBOC governor has been pledging, but they haven't really moved towards that yet because, as I said, they've been prioritizing supporting the yuan for now. But in terms of boosting consumption, according to the government work report, they will be promoting income growth. They will be raising some of the benefits, for example, the medical benefits, the pension benefits for rural residents by 20 to 30 yuan. And that's only just $2 to $4, pretty meager if you ask me. So to what extent that would actually cause people to lower their precautionary savings is still a big question. Of course, they're also doubling the amount of subsidies that would go toward that equipment upgrading program to promote people buying more household appliances and gadgets. But we'll have to see how the actual implementation of these policies will take place in the next weeks and months.
Min, thank you so much for joining us. Min Lo there in Beijing. This is Bloomberg.
Stay set for your trading day on this Wednesday. More retail earnings before the bell. Foot Locker and Victoria's Secret. We'll also get economic data, ADP, that comes at 8:30 a.m. ISM services and durable goods at 10 a.m. The Fed will also release its beige book at 2 p.m. And the event that you do not want to miss that will likely move markets, it is Commerce Secretary Howard Lutnick at 8 a.m. Eastern Manus.
Indeed. And stocks to watch, Danny. Autos, banks, and chips all get that nice bounce because we want to understand from Commerce Secretary, don't we? He said, yes, it's not a pause. Well, then, if it's not a pause on Canada and Mexico, what is the relief?
Well, that is it for Bloomberg Brief. Surveillance is up ahead with the conversation with the Commerce Secretary. This is Bloomberg.